services to banking experiences and financial experiences. So what does the customer actually want? What do they do in their day-to-day lives? How do they want to be using money? So these are things that banks traditionally actually don't provide. They provide loans, they provide access to funds, but they don't actually know you. They don't care about you. They don't really think about your circumstances from a very personal perspective. So our belief is actually there's going to be more of that, and the people that actually matter are your friends and family, are your networks. They're the ones that are going to be there to help you. They're the ones that are going to be there to provide you the advice that you don't get at banks or at big like personal financial wealth managers. They're the ones that are going to be there looking at you day to day, and how do they impact your financial decisions? How do they impact the way you do, way you manage money and way you do financials? So our future is actually more peer-to-peer stuff. It's more friendship related. It's more network based. It's not organizations based, and that's the fundamental principle of what we're trying to build with Cashbar. And I guess during the discussions I can give you more detail about that. But I think that's one of that core fundamentals.
Okay, fantastic. Thank you. And I didn't even have to sort of yank you off the stage. So
can I
there you
use
go.
extra time?
You can. There you go. Just for you.
So I'm at Monash Private Capital, and we were one of the founding general partners of Our Crowd, which is based in Jerusalem in Israel. It's quite interesting to see some of those slides, and I actually hadn't reflected on it until then. I actually don't know whether disruption is the right term, because it's really just innovation and evolution. And so if we think about, go back sort of 10 years ago or 15 years ago, I remember seeing the first person with a sort of Nokia with a little add-on attachment camera. I was thinking, why would you need a camera on your phone? Like, isn't that just intrusive? And of course now my 5-year-old wants a phone with a camera on it. So it's more an evolution of where technology takes us and how we can use that technology to do things better. So is it disruption, or is it just what history has taught us over time? Similarly, you look at go back to Fairfax, and for years people picked up the newspaper to find their property or to sell their car and things like that. Those websites ended up being a lot larger than Fairfax itself. They missed the boat on that one there. So I don't know. Personally, I think disruption's a cool term, and great, wonderful, but it's just evolution of technology and how we use that better, and particularly for larger organisations, how they can get whether it's costs out or become more efficient in their delivery of things. So seeing these fintech disruptors or seeing these companies who are attacking the big beast. I actually don't think that's a bad thing for large organisations, because if they can be more efficient and they can do what is at their core better, then that should actually help their organisations, it should help their shareholders, it should help their customers if they can incorporate it into their model. Obviously, if it's a complete replacement, then that's a different story. But I think the vast majority can actually fit in. On the funding side, so we Our Crowd is very much around crowdfunding, but the term crowdfunding I think is a bit of a funny one. Our Crowd doesn't actually look at crowdfunding in terms of just throw up every idea and see which one gets the most money. Our Crowd actually spends a bit of time curating, negotiating a deal, finding the right ones, making sure that the deal stacks up, the opportunity stacks up, and then allows investors, sophisticated investors, to choose where they put their money into. So there's a bit more than just sort of spray it up and hope that something works. But if we actually take it at the local level in Australia, the ASX is crowdfunding. Why is the ASX crowdfunding? Well, the history of Australia is around mining companies. What do mining companies teach us? They teach us, here's a plot of land, I've dug some holes, I think there's something here. I think there's some gold here, I think there's some iron ore here. Give me some more money and I'll tell you how big this is. So you give them a bit of money and then they dig a bit longer and they say, actually, our cash costs have gone up a bit, we need a bit more money, can you throw a bit more in, and eventually some of them make it to be big mining companies. Some of them, the vast majority, don't. So that's really not a lot of difference between the vast majority of startups which we see coming through our doors. We hope every one of them makes it lucky. We hope every one that we pick makes it lucky. But that's not really too different to what we've seen in the Australian market. That's actually also why we think the prevalence of companies doing reverse listings and companies are listing on the ASX and investors getting excited about that. It's I guess it has a lot of sort of parallels to us, to the resource industry, and that mentality of hopefully we've got a lotto ticket here.
Okay, fantastic, thank you. Simon.
So I'm going to speak initially with my peer-to-peer lending hat on from my time at Society One. So what is peer-to-peer lending? It's businesses that operate platforms that disintermediate banks. They directly connect borrowers to lenders without a balance sheet in the middle. So the lenders are providing their own personal balance sheet and they're funding individual loans or fractionalised portions of loans. The benefits to borrowers are that you can offer these loans at much lower rates than banks traditionally would, and the product, the online service that's provided, the accessibility to the loan is much quicker, much easier, much more accessible than through a traditional bank. On the other side, on the investment side, it provides access to a loan asset that an individual investor wouldn't otherwise be able to obtain at a much higher yield than they can get for most other debt-like asset classes. That's peer-to-peer lending in a nutshell. What do the big banks say about it? So, looking at the slide that was on there before, CBA says exactly that. We've been around for 140 years. They don't have any capital, they don't have our balance sheet, they don't have our credit underwriting history, they don't have our data, they don't have our people, nothing to worry about. It's all hype and it'll go away. What's happened? In the last 5 years, close to $250 billion of loans have been written globally. Majority of that in China, large amount in the US, and smaller amounts in Europe and Australia and New Zealand. It seems to be a shift towards a business model that is incredibly attractive both to borrowers and to investors, and volumes are looking to reach maybe $500 billion in the next 2 years. It's a huge slice of the banking pie. Why is it able to happen? So, those of you who've read Clay Christensen, the Investor's Dilemma, you see that companies tend to focus on the higher value area of the market and they ignore less valuable, lower margin areas. It enables disruptors to come in and innovate, not sustaining innovation that just builds better product for the higher portion of the market, but actually displaces the incumbents from the lower portion of the market where the incumbents don't want to compete anyway. If you look at personal loan products and small, medium enterprise loan products in Australia, you either can't obtain an SME loan at all if you're an SME business, or if you're an individual, you can only obtain personal loans at very high interest rates. Banks don't want to play there either at all or at the margins that the borrowers are looking for. So along come peer-to-peer platforms, they price those products properly, they offer online services that are incomparably better to those that the banks can offer, and all of a sudden you've got an entry and a foothold into a market that the bank then, as we've seen in Australia, retreats away from. They're not competing head on, they're trying to talk it down until it's too late, and the disruptors keep competing away the market until they've made fatal inroads into something that might have seemed a pinprick at the outset. So I would say that actually peer-to-peer lending is an example of disruptive innovation as Clay Christensen defines it, and I'd say that the only thing the big banks can do right now is hit back hard where it hurts them, which is drop their margins on personal loans, open up access to small, medium enterprise lending before the disruptors take hold and ultimately push the banks out of those sectors, and then expand from there to reduce them even further.
Fabulous, thank you. And look, there's about 10 seats up the front here. So those of you who've come in later in the sort of way down the back there, please feel free and take some seats, because they're a bunch of like front row seats. It'll cost you no more, I promise. No extra charge for front row stall seats. So, okay, please, Richard.
Richard Davies from IBM. So I have quite a different background from the rest of the panel. I have a technology background, and I'm focused primarily on blockchain, so my comments will be more through that lens and how that is a disruptive technology. And I'd like to try and give you a bit of a balanced message. There's a bit of pessimism and a bit of optimism there as well. So blockchain, I unfortunately don't have time to explain it in any detail here, but it is a complex technology and it's often still a misunderstood technology. So a lot of organisations are still struggling to even understand what it is and what it can do for them. There's also a lot of similarities between parts of blockchain and what the organisations already do, and that also causes additional confusion. In terms of taking advantage of blockchain requires a network of trusted parties to interact with each other to get value out of it. And in the financial space, this is often an area which is heavily regulated, and this also constrains what are viable use cases for the technology. There are also current technical limitations that companies who try to use the technology bump up against. So there are fundamental limitations around performance and scalability. There are limitations around privacy and anonymity that have simply not yet been solved adequately by the technology. So this is really cutting edge. IBM, when we talk to customers about this, we say to the partners that we work with now, don't expect to get any kind of system realistically into production in the next 12 months. You know, it's still really very, very cutting edge. From the perspective of disruption, looking both at the sort of the top end of town that IBM deals with, as well as the smaller end of town, the startups, larger financial organisations really struggle because they've got such cumbersome IT systems, and their business model doesn't really support the startup mentality often. Even when they try to do things like host hackathons and things like that, they often don't go anywhere afterwards because they don't have a go-to-market strategy. At the smaller end of town, often what is missing in this space is the customer base and the regulatory authority to do some of the things that blockchain requires. So there often is a partnership required between startups and larger end of town in order to actually achieve a blockchain-based solution. So another thing that we've noticed as well, so starting to get to the more positive side hopefully. So the fintech area, we do find, as you've seen, there are already a lot of ideas around in the fintech area that exploit blockchain. Those that are feasible often have, I think, already hit the market now. There are still some blockchain-based ideas that have not hit the market, but the area is getting somewhat saturated. So it's really difficult now to look at a new startup and say, oh, that's something really different in the blockchain area in fintech. However, on a more positive side, I think more opportunities will open up as the technology advances and matures. So it's certainly worth being involved in blockchain now because things are changing and moving forward, and you need to be up with the technology. It is a complex technology in order to take advantage of those changes when they do hit the market. One thing I've noticed in terms of engagement with financial organisations from a startup perspective, often the big four banks have a lot of